Hello and welcome to a discussion on financial statements. In this session, we will recap the financial statements preparation and also try to derive some important performance indicators. So when I say financial statements, the financial statement set includes the opening balance sheet for an existing company, income statement for the year, cash flow statement for the year, and the closing balance sheet. So as we have seen in the past, every financial decision, or rather all financial decisions, will find a place in these financial statements. So on the completion of the preparation of financial statements, we can derive some important performance indicators like profit after tax, cash flow from operations, earning per share, net operating profit after tax, which is popularly known as NOPAT, and with some additional information it is possible to calculate the economic value added. So in this session we will understand the preparation, or rather recap the preparation of the financial statements, and then derive some of these financial indicators. So we have this opening balance sheet in place here and a set of financial transactions. So the opening cash in hand is 68,000. Entire stock is sold and that is income. So the stock is sold for 350,000 and that entire sales is for cash. So it is a cash inflow. But whenever there is a sale, there has to be corresponding cost of goods sold, and the cost of goods sold here is 50,000. As a result, since there is no purchases during this period, the stock becomes zero by the end of the year. Annual expenses for the period, is 36,000, and it mentions that we paid that during the period. So payments expenses is 36,000, no outstanding. Interest for the period is 12% on the loan, and let us assume that interest also has been paid. Otherwise there will be an outstanding interest for that period. Depreciation for taxation is different from the depreciation on accounting, and here we'll recognize the show depreciation for accounting. And depreciation is not a cash outflow but a reduction in the assets. So the reduction in asset will appear in the form of accumulated depreciation. So depreciation is 10,000 here and 26,000 in the form of accumulated depreciation. No change in the plan because we did not purchase any asset during this period. Now since all the items on the income statement taken care, let us find the profit before tax. So PBT, and PBT is equal to 350 minus 102, 248,000. But to find the tax, it is necessary to prepare the tax statement, and tax statement will have almost all the items shown in the income statement with few changes, and let us observe those changes. Sales same 350, COGS same 50, expenses 36 same, interest 6,000 same amount, but depreciation is 25,000. It's possible that a firm can have different depreciations for income statement and for tax statement. So the total expenses under the tax for the purpose of tax calculation is 117,000. So the taxable income is 350 minus 117. So it is 233,000. So the tax payable, is equal to 30% of 233,000, that is 69,900. And according to the accounting standard, that the tax has to be shown as the current tax. But the accounting standard also says there is a need to show the deferred tax, and the deferred tax is the tax on the timing difference, and the timing difference here is the difference between the depreciation in accounting and depreciation in taxation. So the timing difference is 4,500, and that is shown as the deferred tax, and the current tax is shown from the tax which is calculated as per the tax statement. But the payment, the actual payment or the cash flow, the company is under obligation to pay the current tax, and the deferred tax is shown on the balance sheet as a deferred tax liability. So let us recap that. Current tax is shown as per the tax statement. Deferred tax is the tax on the timing difference, which is the depreciation in this case. The cash flows effect is of the current tax, and the DTL is the deferred tax becomes the DTL in the balance sheet and will continue to remain as a DTL as long as this asset continues on the balance sheet. So the profit after tax now can be calculated, which is 69, and so 173,000 is the profit after tax. No information given, so let us assume that entire profit after tax is retained. Let us find the cash in hand. The cash in hand is equal to cash inflow minus the cash outflows, or cash available minus the cash outflows, which is 306,100, and the cash in hand becomes shown as an asset on the balance sheet. So cash flow statement and the income statement are done. No change in the capital, no change in the loan, no change in the outstanding expenses, no change in the creditor. So the sum of all the sources is 410. No change in the debtor. So the sum of all assets will be the summation of plant, stock, debtors and cash, which is 410. So we have converted a set of transactions into financial statement. But let us spend some time on the cash flow and present the cash flow as per the accounting standard, which says find the cash from operation. Cash from operation is sales minus expenses minus taxes. Cash from financing is a reflection of the money received from, or cash received from, the financing activity. Here there is only interest, no inflow but only outflow. And cash from investment, there is no cash inflow from investment, no cash outflow from investment, so cash from operation is 0. So the summation of opening cash, CFO, CFI and CFF is same as cash in hand. But the business has generated a cash from operation of 244,100. But at this juncture, we should also be in a position to answer this question. The company has a PAT of 173,000, whereas the cash in hand is 244. So the question should be, why is PAT not same as CFO? We know that PAT is not as same as CFO because of non-cash items, because of non-operating items, and because of the changes in our working capital. Let us see that. So depreciation is 10,000. We add back non-cash. Interest is non-operating, so we add back. Working capital changes. Working capital changes. So debtor, in this case, no change in the debtor, no change in the debtor. In this case, the stock has reduced, so that means we use the stock purchase in the last, so therefore it should be added back. Creditors, no change in the creditors, no change in the creditors, no change in outstanding expenses, outstanding expenses, no change in outstanding expenses. So therefore the cash in hand, cash from operation is equal to the summation of profit, non-cash, non-operating, and changes in the changes in the operating cash flows. What are they? Profit after tax 173, depreciation 10,000, interest is 6,000, debtors no change, stock 50,000, creditors no change, outstanding expenses no change. The CFO is 239,600. Let us observe here, that is expenses minus, yes, and also there is one more non-cash item, that is deferred tax, and the deferred tax is 4,000, so 11. Okay, so 244,000. So profit after tax is not same as CFO because of non-cash items like depreciation and deferred tax, non-operating items like interest, and working capital changes. In this case, it is only the stock in changes in the stock. So we have we got PAT, we got cash in hand, we got CFO. We also understood why CFO not same as PAT. Now one more item we should like to would like to calculate here, that is net operating profit after tax, which is PAT, that is 173,000, plus minus adjustment for the financing and accounting anomalies, and the financing anomaly is interest. So add back interest into 1 minus t into 1 minus t. So therefore interest into 0.70, and then we will add back the deferred tax because the EVA calculation recognizes only the current tax, not the deferred tax. So NOPAT is unlevered profit of the firm without the accounting adjustments like deferred tax, which is 183,300. The NOPAT is used to compare with the capital charge, and in order to find capital charge, it is necessary to prepare an economic balance sheet. An economic balance sheet is a variation of the accounting balance sheet, and let me write down as EBS. So EBS, in this case, the capital is no different. Loans have no change. We are all calculating that as a book value reserves same, outstanding assets, expenses same, creditors same, but it will not recognize the deferred tax liabilities. So since EBS recognizes only the current tax, EBS is the economic balance sheet required to calculate the capital charge. Plant, we are taking the book value for the time being, no change in the depreciation, no change in the stock, no change in the debtor, no change in cash. So the asset values are same, but the difference, we call it something called equity equivalent, and that is the accounting adjustments required to convert the accounting balance sheet into economic balance sheet, and that is an important item for calculating the EVA. So EVA requires the calculation of the capital charge. The capital charge here is equity capital plus reserves. The loan, 12% loan, which is 50,000, and EE, which is 4,500. So 12% loan, okay, 12% loan, and the cost is given. The cost of equity is given as 18%. The cost of equity is 12% into 0.70 is a post-tax interest rate. Okay, 12%. So 12%. So post-tax interest rate. Then the equity equivalent is also calculated at 18%. So the cost of equity, cost of debt, and cost of equity equivalent together will give us the capital charge. So EVA is equal to NOPAT minus CC, which is 182 minus 58. So 123,000 is 123,578. So in this exercise, we converted the transactions into financial statements, and from the financial statement we found the cash from operation, and we also try to understand why the cash from operation not same as PAT. From there we got into calculation of NOPAT and EVA, but EVA calculation requires the calculation of capital charge, and the capital charge requires the calculation of this economic balance sheet. Economic balance sheet is not necessarily follows the generally accepted accounting principle. So some of the accounting adjustments which are done to convert the accounting balance sheet into economic is given a name called equity equivalent. Thank you very much.